This is the most popular strategy in larger multifamily deals, as it allows us to participate in the upside of larger deals while diversifying the risk against a larger pool of doors. So you're new to real estate investing, or you want to level up potentially to multifamily real estate investing, but you don't know where to start. Today, we're going to be talking about the most popular way to get into larger multifamily apartment complex deals and scale your portfolio while mitigating your risk. Hi, I'm Brian Force with Deep Blue Capital, and today we're going to be talking about the basics of multifamily syndications. But before we get started, please go smash that subscribe button, hit the notification bell, and then when you're done, check out deepbluere.com and go over and create your investor profile. That'll give you access to all of our upcoming investment opportunities, as well as invites to our live webinars and in-person events, and all kinds of other cool educational content. So let's say you're either new to multifamily investing or you're an experienced investor that is looking for a way to have more hands-off opportunities while still having passive income, building generational wealth, growing your portfolio. Multifamily syndication is probably the avenue for you. So real estate syndication democratizes access to high-value properties and spreads the risk and rewards across a larger pool of investors. This is the most popular strategy in larger multifamily deals, as it allows us to participate in the upside of larger deals while diversifying the risk against a larger pool of doors. Let's say you have $50,000 to $100,000 to invest in a multifamily property. You could invest that in a smaller deal that you take down on your own, maybe 20 to 30 units, and you're running the operational side, and your risk is only diversified against 20 or 30 doors. Or you could take that same $50,000 to $100,000, put it into a syndication for a larger project where you're completely hands-off from the operational side, you're still generating passive income, and you share in the upside potential, but now your money is diversified against hundreds of units, which mitigates that risk. So what does a typical syndication look like? In a syndication, there are generally two types of investors. There are the GPs, or the general partners, and these are the operators of the deal. They're the ones that find the deal, network with the investors to raise the capital, close on the property, and then execute the business plan and operate the asset for the length of the hold period. They're the ones that make this their full-time job, day in and day out. And then you have what are called the LPs, or limited partners. These are the passive investors who raise the capital, contribute their money to the deal. Once the deal is closed, they sit back, allow the GPs to operate the asset while they share in the upside, collect that passive income, and participate in the returns without having to operate the project. Investing as an LP is how you can participate in larger multifamily deals while still running another business or maintaining another job, but still build a portfolio and create passive income and build generational wealth. So let's walk through the basic steps of a multifamily syndication from start to finish. First, we're going to start with deal analysis and due diligence. This is where the GPs, the general partners whose full-time job it is, find the deal, analyze the property, formulate the business plan, make an offer, decide whether or not this is a doable deal, and get the property under contract. Then they move on to the due diligence period. This is where they're essentially verifying all of the information that formed their thesis for why this property is a good deal, and they're doing formal inspections on the asset itself to ensure that it's in the condition that they believe that it is in, and negotiating any repairs or maintenance with the seller prior to closing. At the same time, the general partner's legal team is normally forming the syndication entities. These are going to be the entities that own the property and manage it as well. These are the entities in which investors, limited partners, are actually buying shares whenever they make their investment. After the property is under contract and we're in the middle of doing our due diligence, negotiating any repairs with the sellers, things like that, now we're also structuring the deal and the offering for our limited partners so we can do the capital raise. This is where we start to network with our group of investors, present the deal to them, see if it fits with their goals and their investment strategies, and gain commitments from them that they're ready to invest whenever the deal is ready to close. Once the capital is raised, all the financing is in line, and we're ready to close on the property, the GPs will formally close on the deal. Then we start the transition from the sellers over to the new owners and any transition of property managers as well, so we can start to execute on our business plan. Once that transition's done, the GPs and their team are now responsible for the asset management and executing on the business plan for the length of the hold. Most syndications, especially in multifamily, have a hold period of about 3 to 7 years, but about an average of 5 years for a business plan. That means that the general partners, their property managers, their asset managers, their job now is to execute on the business plan, keep investors updated on how things are going, manage their disbursements and their distributions to the investors in that form of passive income like we talked about earlier, and then eventually do what's called disposition, selling the asset at the end of the business plan and getting a massive payout, hopefully, for their investment partners. So now that we've talked about the basic steps in a multifamily syndication, I want to talk about some of the key terms that is crucial for you to understand if you're thinking about investing in one of these types of deals. The first is going to be equity splits. Equity splits define the ownership distribution between the LPs, the limited partners, and the GPs, the general partners. Common equity splits between those two classes in the deal are anywhere from 80-20 to 70-30. The next key term is called preferred returns. Preferred returns define the minimum return that the limited partners are going to receive on that deal before the GPs share in any of the profits. This ensures that the limited partners are always taken care of first and provide motivation for the GPs and the operator to perform at the highest possible level. The next is going to be a waterfall structure. Waterfall structure defines how the cash distributions from the deal are going to be divvied out after the preferred return is paid. This is oftentimes a multiple tiered structure because many multifamily deals have different share classes that you can invest in. And so the waterfall will hit those share classes differently based on the offering memorandum. The last key term is liquidity event. The liquidity event is when investors can either recoup all of their investment or exit the deal, normally through a refinance or sale of the property. So oftentimes in a multifamily syndication, you will refinance the property at some point during the hold period and recoup a majority or sometimes all of your initial investment. You'll also get a big return on your investment if the deal goes well when you sell the property. Those are two different types of liquidity events. So there you have it. Multifamily syndication is a strategic way for investors to participate in larger multifamily opportunities while pooling their funds with different investors to participate in the upside while mitigating their risk and diversifying it across many more doors than they would likely be able to participate in on their own. If you're interested in learning more about multifamily syndication or you're ready to start your journey, connect with us at deepbluere.com and create your investor profile so you get access to all of our upcoming investment offerings, as well as invitations to our live events and webinars and a whole bunch of other great content. Appreciate you watching. Hit the subscribe button. We'll talk to you next time.